Hey, Thomas, how are you?
Jonathan, I'm doing fantastic, brother. Fantastic. How you been?
Doing good, doing good.
All right.
Thanks.
What I want to talk about today, September 17th, the Fed is scheduled to meet tomorrow about cutting the interest rates. They're talking about a quarter, possibly a half a percentage. So, basically, if you could pull up that first article I had sent you, could the federal interest rates, could they boost the stocks or sink them? Here's what history says. And it's kind of interesting because since the mid 80s, Goldman Sachs has been keeping track of this. And, there was Vicky Chang, who's a macro strategist for Goldman Sachs. She says out of the 10 times the Fed has eased monetary policy, four of these cycles have been associated with recessions. Six were not. When the Fed succeeded in staving off a recession, stocks tended to rally, and when it didn't, stocks tended to slide. So, what's interesting about this, we do know that, and we've spoken about this in the past, there is a consumer, actually, it's a commercial office space, problem. And there's a lot of bankruptcies happening with the sale of a lot of these loans that were out on these commercial buildings. And it's putting the banks in jeopardy, which we'll get a little bit further into that as we get into the podcast. But just as, things happened, in 2008 and 9. Now, if we could bring up the next article, what happened on September 18th, going back 17 years ago on 2007. All right. Basically in Jackson Hole in August of 2007, the global credit markets were freezing up. And I remember this very, very well. Okay. This was the global collapse of the mortgage industry. So you had Chairman Ben Bernanke at the time. He singled rate cuts ahead of the Fed's Jackson Hole conference late that month, followed up by a 0.5% rate cut in September. And what ended up happening, 362 days later on September 15th of 2008, and if you can pull up the next article, it was the collapse of Lehman Brothers. Now, Lehman Brothers was a huge institution that was around for over 150 years. It was one of the creme de la cremes of Wall Street, and it collapsed overnight because of the mortgage industry. The mortgage industry ended up, and Wall Street played this game. They did what they called CDOs, collateral debt offerings, where they packaged all these like fraudulent mortgages and sold them off to pension funds around the world and countries to invest in. And it blew up in their face. That's what ended up happening. Now, if we go to what's going to possibly happen tomorrow with the 0.25% to a 0.5% rate cut, and knowing what's happening in the commercial office space industry across the country, especially in the major cities, New York, Boston, Cleveland, Detroit, Chicago, LA, San Francisco, what do you think this is indicating in your opinion, Jonathan? Because I know you're not as well versed in this as I, but some of the stuff that we had through conversations, what do you think?
I mean, we've seen it over the last, 4 years, since COVID, really. We've
Oh,
seen
without a doubt.
we've seen how interest rates across the board raised everything, right? So
Mm-hmm.
people couldn't get, their hands on more money anymore because now the interest rate instead of, 2%, 3%, now it's, 6, 7, 8%, sometimes 9% to get a house, get a mortgage. But that's not just for houses. Any if you want like a business line of credit, you want to reinvest or invest into your business, you need to get an office space. Everything is increased. What the office space that very interesting throughout the years, COVID happened. A lot of people work remotely now. Um, you would think that office buildings are looking to get people in as quickly, and they'll take whatever they can get. But it's been quite the opposite. We've had um, our fair share of getting different types of offices, and the landlords, the real estate brokers, they're looking for like very high rents right now.
Hmm.
So and there's the vacancy in a lot of these buildings is high. So we never understood. I mean, normally if you're a landlord, you want to get someone in there as soon as possible, as long as
Hmm.
they're good. Obviously, you want to get fair market, but what's preventing them from renting it is these high interest rates.
Hmm.
You don't know where they are if they're on like variable rates or if they're on some type of mortgage plan that changes every 5, 10 years, and their interest rate went up. But we've seen it disrupt the office furniture building industry because people not only can't get office space, they don't have money to buy furniture. They don't have money to reinvest in their company. So
Hmm.
it's been a thing that I've been tracking. I do, real estate, like and it's caused a lot of disruption, honestly.
Well, I'll tell you this, and I've said this in the past, when it comes to the interest rates, they're not really high. Okay. People were spoiled over, since the collapse would happen in 2008, 9, 10, and 11. They were
Yep.
spoiled for a long time having low interest rates. Listen, when I started, investing in real estate in the early 90s, basically, it was like 8%, 7%. That, I personally feel it should be a minimum of 5% interest rates everybody gets on their money in the bank. That's the way it should be. You know, um, all this low free money is actually put us in the problem we are today, and that's what's happened. What I feel what's going to be on the horizon, since the Goldman Sachs with the what do you call it, Miss Vicky Chang said, they've done it 10 times. They've seen the rates drop. It's going to be 11th time. Usually, what happens is, in about a year's time, you're going to see a major recession. That's what you're going to have. You and I in December had talked about what was going to happen in 2024 economically, but I said beware of 2025 back in December. That's going to be, the bad year. And I still feel that way. That's what's going to happen. They think they have inflation under control. I think what's going to happen, inflation's going to spike up again, especially if they do a 0.5%. The dollar has weakened, and that's what's been going on. So the government has been destroying my money that I worked hard with, and other people who have money saved and invested in. They're destroying our dollar over their bullshit moves that they've been doing, and I blame the federal government on that. And it's only going to weaken our value of our dollar even further because they're basically a bunch of bastards. What it comes down to, they don't give a shit about the people that have done the right thing and saved their money. They just want to create more free programs. So we really got to get a hold of what's going on. I do not think the interest rates should go down, but they're going to. They're going to pull the trigger. You're going to see the market go up tomorrow and the rest of this week. The market hit a record yesterday. It hit the 42,000 mark on the Dow. It's amazing to me because I know businesses out there are suffering, and so do you. So why is this happening? Because it's a lot of fraud going into the market. Your thoughts on that, Jonathan?
So the big difference that we see is that, okay, let's talk about I used to work in the mortgage business, when I was in like college,
What
and
what what years were those, Jonathan, that you were doing that?
2005, 6, 7, 8.
All right, so you know what,
Yeah,
you were working, in 5 and 6. You were probably seeing people making buku dollars, and possibly yourself too, right?
we did. And at the time, you were right. Interest rates were, I remember it because interest rates were like 5 and 3/8, 6, 7, 7.5. That's where the majority of the interest rates were. You never really saw, you started seeing interest rates go into the threes in 2009, 2010, if I recall proper,
Yes, yes.
and the big difference is that back then, housing was, at least in New York, housing was affordable.
But hold on. When you were doing it then, because I knew a bunch of people, and no offense to them, they were morons and they made a shitload of money. They weren't professional salespeople because everybody was qualifying for a loan back in 5 and 6, right?
Well, what they would do, right? No one had money to put down, so what they would do is
Yes.
they would buy, the subprime mortgages. They would buy with like balloon payments, or they would buy with nothing down payment. They would no down payment. They would do a first loan and a second loan, so they didn't have the PMI insurance. There was a lot of things that they did to get people mortgages, which they should never have had the right to have those mortgages, and obviously eventually they collapsed and they foreclosed, and that's why in 2008, 9, 10, 11 there were so many foreclosures. But you would buy a house, $300,000, $400,000 in that
Hey,
time.
Jonathan, not to interrupt you, but while you're talking about this, bring up the fourth screen because this is exactly what we want to speak about. Well, what you're speaking about is basically how Lehman's is collapsed 15 years ago when this article was written, changed the U.S. mortgage industry, and this is from NPR.org. So continue speaking what you're about because this falls right into the category.
Yeah, so like the main difference I see from now to then, because I bought houses in both times. I bought houses, as early as then and as recent as now. And now, I mean, in Nassau County in New York, you're getting a piece of garbage house for $800,000 nowadays.
But
Whereas back,
you know why that is, okay? Because the dollar has lost so much value and inflation on top of it. That's the big reason why. Continue.
right? So like back then, same thing. Back then, you would get the same house probably for $400,000,
Are you
four
get
hundred fifty.
back in 6 and 7, that same house was going in the threes.
Yeah, so the difference is that people are not seeing that increase in salary or that increase in, so let's say,
Bingo. Yep.
it went up 100%. So from in 20 years, let's just call it 20 years, make it easy. Real estate, let's just take Nassau County went up 100%. The same
Yep.
house was 400, now it's 800. The interest rate was same thing, probably 4%. Now let's say it's 8%. The
Hmm.
salaries have not gone up from, let's say, a $50,000 salary. It's not $100,000 salary now, or 150,000, and it doesn't even matter because
It's
that
probably about 72, 75,000. That's probably what it is.
and that's outside of everything else. So you sent me a
Correct.
graph a few days ago about how things have gone up over the last few years, and that doesn't tell 100% the true tale because like we go to you go to the supermarket, see how much milk is, see how much eggs are, see how much
Hmm.
bread is. Whereas
Yep.
back then you can buy like a dozen eggs for $1.99. Now it's
Hmm.
like now it's like sometimes you have no options. You see what it is. It's like 8.49 for a dozen eggs. It's
Hmm.
4.50, $5 for for milk.
Hmm.
Whereas back then you can get like a dollar, anything was like $1.99. So it just hasn't kept up, and it's, let's say, even if it was close to catching up to where it was,
Hmm.
people are not able to to get around the corner so they can actually make and save money. Most people are living paycheck to paycheck or month to
Hmm.
month, whatever it may be, however they get their checks. It's a problem, and the interest rates going up or down. I think the real big issue is that right now housing is so expensive. So if interest rates go down,
Hmm.
that's going to make housing go up even more because
You,
now,
you know what? Thank you. I actually spoke to a few real estate people who are my clients up in New York, Boston, and that's exactly what they said. What you just stated. It's going to go up, the housing price, because the interest rates go down. So where do you sit then, right?
I mean, I mean, do you still sit on the sidelines? Do you get in? Do you try and? It's a very tough call because if you're trying to buy your first house, or you're trying to buy your investment house, whatever it may be, you don't want to get in at the wrong time, and all of a sudden things drop down. But I have some very close friends that are in real estate as well, and they've been
Hmm.
telling me for the last 20 years, don't buy now. It's a bad time. It's a bad time.
Hmm.
You have to figure out when is the right time for you to buy your first
Hmm.
house or whatever you may want to do. But you just need to, it's a difficult decision for anyone that's trying to get in.
It's, you know what? Again, when I think what's happening, I think this is all engineered. It's, again, I'm going to say Klaus Schwab of the World Economic Forum, his book, The COVID-19, The Great Reset, his famous line, "You'll own nothing and be happy." They're going to the houses, the price of houses are going to keep going up. I don't see them going down. If you draw a smile across the Southwest to the Southeast, that area is growing in the country. Where you are up in the Northeast in New York, Metro New York, Long Island area, prices are going up as well. People are getting outpriced. It's unaffordable, and that's what it's going to come down to. And, people are going to have to start going back to what they were doing in the 30s, 40s, 50s, and part of the 60s. It's having nuclear families, grandma and grandpa in the same house as the kids. That's where we're gonna to survive. That's
I
what you're
think
gonna
you're
have to
starting to
do.
see
Come
that.
on.
I think you're
Yeah,
starting to see that because I know even a few people that I work with, like their older children live with them. Like I'm saying in the 30s.
yeah.
So it's yeah, I mean I think that's going to come more and more into play with not being able to, afford a single family house. I mean, in this day and age, who's going to be able to graduate high school, go to college, get out of college, have all that college debt for the loans, and then buy a house for $1 million to go into a job? I mean, the real problem is that you can't do anything without spending a lot of money, right? You go out to
Mhm.
get lunch, it's gonna be, a bill. You're gonna go,
That's,
go to
that's
dinner, it's
it.
gonna be two, three bills. No matter what you're doing, you're spending money. So unless you just sit home isolated watching TV and, shopping at discount stores, you're spending money.
Hey,
It's
let me ask you this question. Just going to a local deli there in Nassau County or Suffolk County, just to get yourself a hero sandwich from that deli and a drink, what's it costing on the average, would you say? About 15 to $17?
I went with a client. We went to get lunch, not even like a late breakfast at a bagel store.
Okay.
It was what was it? It was $38 for two sandwiches.
Are you serious?
Yep.
Holy mother of God, man. That's insane.
30, and we had like Lipton half and half iced tea and whatever. So figure
Wow.
plus, with two drinks, $38 for a late breakfast sandwich. Uh Now
Totally insane.
it's yeah, I mean, it's you don't know, like I'm saying, like you go out, you want to get a couple burgers, it's $50 for, two burgers if you're going out anywhere. And don't even, add drinking, if you have a beer or something, forget about it. So it's just really wild how things have changed and, very quickly. It's not,
Mhm.
it wasn't so long ago that you can go out and have a good dinner for, for two people under $100 without drinking, of course.
Sure. Hey,
Uh,
do me a favor. Pull up the last screen there so we can get into that conversation because this is where it's leading to. All right. Yeah, I mentioned this, before. It's in regards to the commercial real estate, the loans, a
yep,
ticking time bomb for U.S. banks. So just as you had, let's just go to the headline for a second. Scroll back up. All right. So that headline, commercial real estate loans, a ticking time bomb for the U.S. banks. Now, think about when we started this podcast, when I was just talking about where, Lehman Brothers, they ended up, 362 days later after the Fed cut September 18th. Kind of funny because tomorrow's September 18th in
yeah.
2007. And then in 2008, the global collapse. Okay. So are we looking at something where we're going to have a global collapse within 12 months, where not only in this country, but it's going to also hit the Western world as well over in Europe? I will say this: the world has changed since COVID because, you look at the metro New York area, Boston, Philly, Cleveland, Chicago, the bars aren't the bars anymore after work, the happy hour and stuff like that. It doesn't exist anymore. That's the problem. So that's hurting all those businesses, the foot traffic at lunchtime going into the boutique stores, etc. Everybody's hurting. And what we spoke about last week about the amount of legal and illegal immigrants that have been hired. 2.9 million legal and illegal immigrants have been hired within a 4-year period in this country. And there's 183,000 less U.S. workers in that same period.
Yeah.
So, these are telltales. This is what it's leading to. Your thoughts, Jonathan?
It's funny because I talked to a potential client a few months ago who owned a deli in Plainview, and he said that his business is like collapsing ever since COVID, ever since talk about commercial real estate, ever since these office buildings aren't completely filled. People
Mm-hmm.
are he lost 80% of his lunch business, he said, and that's his big business for any deli, breakfast, lunch. So he's like, I'm not getting the orders I was getting before. He's having to do like the Uber Eats and, to try and get people that are a little further away to order because the
Mm-hmm.
the buildings that were across the street aren't filled up anymore.
Yeah,
So those are like the ripple effects, right? The people aren't
exactly
working
what
in
I
the office
said. And
buildings.
And that's a great coin way of putting it. It's the ripple effects, like throwing a stone, a
Yep.
pebble into the lake, and just watch the ripples. This is how it's affecting other businesses from these commercial buildings. You're absolutely correct, Jonathan.
And that's like even in the city, right? So you would go to the city normally, you have a couple meetings or you work there, you like you said, happy hour. If you don't have the crowds, these one by one, all these restaurants, all these delis, all these stores are not what they used to be. Even if they are still open, they're not like they. You go to a happy hour because you want the crowd, you want to be around all the people. So if you go in and it's like a dive bar, it's not the same anymore. So
And you
continues,
know
right?
what, Jonathan? It's not only, going into that bar and having fun, listening to tunes. It's the networking and the socialization of the networking and the business deals and the connections, and the job leads and the opportunities that have disappeared for people. They're not there anymore. And believe it or not, that old happy hour was a great way to create and do business and make money and get future positions at other companies. It's not existing anymore. And it's so sad because it was such a great avenue to make that happen.
Yeah, I mean, so continue to be, changing, no for a deli, for a local, restaurant that focused on business with office buildings. They're not filled up. They don't get the orders. That guy's got to go out of business, or that guy has to downsize, or figure out how to, generate more revenue, how to stay afloat, fire people, or get less qualified people that paying them less.
Mm-hmm.
Kick in the fact of any illegal immigrant that comes here takes jobs from Americans that are looking for work, or maybe they're both as qualified as one another, but the illegal immigrant you don't have to pay him as much. So guess who they're going to pick? They're going to pick the one
Exactly.
that's cheaper. So
I,
it,
I
it's
I'll say this. This is my final thoughts.
yeah.
They're going to cut tomorrow. You're going to see the markets be bullish, and watch 2025. Doesn't matter who's in the presidency. Okay, the economy is going to get hammered. The only difference of who's going to be in the presidency, if it's Trump, I think he can get us out of it a lot quicker. But if it's Harris, we're going to go a lot longer and go deeper into 26 and possibly 27, and it could be a real long, hard time for a lot of people, and it's going to hurt a lot of the average middle class in this country. That's what it's going to hurt, especially the working class people, like you're talking about. $38 for going to a bagel store for 2 sandwiches, you and your client, and a Lipton iced tea. Doesn't make sense, people. Got to wake up and start looking at things, because the leadership we have in this country has been piss poor over the last 3.5 years. And, we'll get into our Friday podcast on it. But as far as we're talking today, we're looking at the Fed and the future, what's going to happen with businesses out there. And it does not look good. Definitely not. Any closing thoughts, Jonathan?
It's good. It's just hearing you say that it's scary that to think that things can continue to get deeper, darker than it is right now.
Mm-hmm.
Because as bad as we think it is right now, you're still able to live. I mean, this could get really ugly in the next few years, if not sooner.
Oh, I think
Uh,
so. Most definitely. That's my thoughts. Yeah.
yeah. So just stay on top of. I mean, what's an interesting thing is that for the everyday person out there, that's just living his life, supporting himself, his family, is him and his wife, or however it may be. Who and what should they do in the future or for right now to save or to be ready for the future? That's like a scary thing for a lot of people to have to think about, because what you have today may not be there next month.
100%. Listen, hopefully this has been creating knowledge for you. We ask you to hit that thumbs up. Please hit that like. If you haven't subscribed, please do. And I ask you to, if you could share this video and just send it out to other links to other people that we greatly appreciate it. We're starting to get some heavy traffic on, the last few videos we did, and we want to keep growing because we got solid information for you, and it's truthful information because it's facts. You guys have a great day. Enjoy the rest of the week. Take care.